Hi, and welcome to this introductory webinar on the Wealth Academy program. So I believe you're listening to this because you want to create another source of income for yourself, or you want to, grow your savings at a much higher return so you can build your wealth a lot faster. So in this short webinar, I'm going to show you the most effective investment strategies that you can use to achieve consistent profits from the financial markets. And again, how do you achieve that financial security and freedom? By having the highest return on your investment capital. Okay. So I believe that whether you are a student, whether you are a teacher, you're a doctor, you're an entrepreneur, learning how to invest is an essential life skill today because, in fact, it's the only skill that can guarantee you an income for the rest of your life. Because nowadays, if you go to university or whatever, and you get a skill like engineering or accounting or programming, these are useful skills. But these skills can't guarantee you a job in 5 to 10 years because you can be replaced by someone who's younger, who's cheaper, who's faster. But when you can trade the financial markets, when you know how to build passive income from your investment skills, then you have no more worries in your life. Because anywhere in the world, as long as you've got a laptop, you have an internet connection, you've got a strategy, you can create income for yourself. So I'm really excited to share with you how you can begin on this journey. And a bit of background about myself. I started investing, I started trading at 18 years old. And the person who was inspired me was actually my grandfather, my maternal grandfather, and how he got me interested was when we were young, we got what we call ang pao, or red packets from our parents and grandparents, right? My grandfather used to give us not cash ang pao, he used to give us share certificates in Malaysian companies because my grandfather used to invest a lot in the Malaysian stock market. So that's how I got interested. And he used to tell me when I was young that he said, now you own part of a company, right? I said, wow, at 18 years old, I own a company, right? It's pretty exciting. So that got me interested to invest. So at an age, I was too young to open an account. So I used my mother's trading account. She encouraged me a lot. And there was no internet in those days. It was the 1990s. So you had to invest by calling the broker on the phone, to check the price in the newspapers once a day. There was no charting software to draw my own charts. And that's essentially how I started. All right, and so I started investing in the Malaysian stock market in the 1990s and moved on to the Singapore stock market, traded in the Hong Kong stock markets, and sometime in the early 2000s, we had what we call online trading, where the internet became a big thing and you could trade shares online. So that's when I started trading in the US stock market. And in fact, that's where I built most of my income and my fortune. And today I focus primarily on the US stock market, plus some in the Singapore stock market as well. So I started at 18 years old, and eventually I built my capital to reach my first million by 26 years old. Right? So if you think about it, that's 8 years. Okay, so the first thing I tell people is that I'm sorry you can't get rich overnight. Okay, there's no such thing. It takes time to build your wealth. It takes time for money to compound. It takes time to master a skill. And it took me 8 years. And eventually, by 33 years old, I managed to get, among the top 25 richest Singaporeans under the age of 40, with a net worth of over, about $9 million at the time. And now I'm 43, in case you're wondering, right? So a lot of people ask me, they said, so am I saying that, Adam, are you saying that I also need 8 years, right, to make my first million? And the answer is yes, right? If you start from scratch, if you learn from your own mistakes and your own experiences, which is what I did. Okay, but I believe that you want to learn from other people's mistakes, other people's experiences. So one of the things that I can do for you, I can show you how you can cut short your learning curve by more than 90%. So you don't make the same stupid mistakes that I made when I started, which was, buying based on stock tips. I'm here to tell you this. Every time you get a stock tip from a broker and you buy it, you're the last person who buys at the top, right? It's too late. Right? I used to make stupid mistakes like buying lousy companies because I thought that the share price looked cheap. Not knowing that I was buying a piece of garbage, right? And cheap got cheaper, right? And the share price either, went to zero or got suspended, And I used to buy companies I thought were good companies, but they were on a downtrend, right? And again, on a downtrend, low gets lower, cheap gets cheaper, I used to, invest and I used to get it right like 7 out of 10 times. But the 3 times I got it wrong, it wiped out all my profits because I did not know how to manage my risk. I did not know how to, cut my losses, right? So I had all these wrong habits and I had no strategy at all. So whatever money I made from the stock market, I lost it just as fast. So for the first couple of years, I was going around in circles like most people. It was only when I realized that, making money consistently from the stock market it's not easy, right? If it's easy, nobody would work, right? Everyone would stay at home and make money by pressing a button on the computer. It is not easy, right? Learning to achieve consistent profits from the financial markets is like any other skill. Whether being an engineer or doctor or lawyer, it takes knowledge, it takes skills, it takes practice, it takes a methodology. So over the years, as I began to find the right method of how to analyze companies, how to buy on the uptrend, how to exit on the downtrend, how to manage my risk, that's how I started to build my wealth exponentially. And I believe that you can do the same thing. So in 2006, I started a movement, a school called Wealth Academy, where our mission has always been to empower retail investors like you to profit like the professionals. Okay, and over the years we have won multiple awards. We've won most preferred financial educator award. I've been privileged to win the most preferred investment speaker award for many years. But the greatest testimonial that I have today is not the awards we have won. It's the students that I have, the results they've produced. And one of the reasons why our programs are so sought after is because my students have been my greatest testimonials, right? I've got students who came who are deeply in debt, some of them who were bankrupt, and after the program they learn how to manage their investments a lot better, how to allocate their funds and grow their capital. And today I've got so many students who have become millionaires. Not overnight, it took time, but eventually became millionaires. And some of them have become multi-millionaires. And I'd like to share with you some of their stories to inspire you that no matter where you are, you can achieve your financial goals. So Bang Pham Van is a student of mine who is originally from Vietnam but has been working in Singapore for many years for a multinational company as a finance director. And he has been trading stocks and options for the last 12 years but going nowhere, not making any money, right? So he came to Wealth Academy about 5 years ago, and the program really gave him the tools to really change his investment style and allow him to achieve consistent profits every single month in the markets. And this was his email that he wrote to me a couple of months back. He said, "Hi Adam, I thought I'll drop you a note to let you know that my stock trades have been quite successful. Reapplying the techniques and tips I learned from Wealth Academy a month ago, my profit last month paid out the course fee handsomely 7 times over." Right? So he made back 7 times of his investment in a month. He said, "One can argue that it's because I'm an experienced investor. Yes, before the academy, I've been trading and investing for years, but my school of investments was purely based on fundamentals without paying close attention to the technical indicators," right? So he could not read trends as well in the past. My return, therefore, was not consistent and not that good. Many times I held on to losing positions with a belief that the stocks would come back, right? In reality, they rarely did. Your unique value momentum approach, together with simple yet effective technical analysis, has enhanced my stock picking effectiveness a great deal. He said, "I feel very fortunate to have attended the academy and learned so much from it. It's worth all the time and money I invested in it." And this was his trading statement that he sent to me from Interactive Brokers. Now, he started with a fairly large capital, one of the biggest for most of my students. He started with about $100,000, as you can see, and he grew his account from $100,000 to $204,000, 105% cumulative return in 9 months. Okay, and that's really impressive. I mean, how many professional bankers and fund managers can achieve 100% return in 9 months? But Bang did it, and he did not just do it once, he's doing it consistently every single year, right? And that's what you can achieve with these investment systems you're going to learn. There's another student of mine. Her name is Davira. She's from Indonesia, and she wrote me this email a couple of years ago. She said, "Hi Adam, my name is Davira. I graduated from Wealth Academy Jakarta in 2014. I want to thank you for your teaching and guidance. Your strategy and rules are very powerful and you are very helpful. Thank you." Right? And she said, "Initially, my dad did not allow me to join your program because he thought that trading is like gambling. But now I can prove him wrong. Trading is totally different from gambling. And after he saw my result on trading, now he supports me." All right, and here's the result. Okay, she made about $10,000 in 4 months, which is from August 19 to December 17. All right, and in terms of rupiah in Indonesia, $10,000 is a lot of money. All right, and if you read what she said, my winning rate, it's high. I did 31 trades on CFDs. I'll teach you what CFDs are in the program. I had 12 losing trades and 19 winning trades. So bear that in mind that to be successful, you don't have to win all the time. In fact, she was only right 19 of 31 times, which is about 60%. But despite that, if you take a look at her trades, right, in 4 months she made over 10,000 US dollars. Okay, and in trading, the reality is that you're gonna have wins and losses. You can't win all the time. It's kind of like a business. In a business, you have sales minus costs, you get gross profit. In a business, you cannot only have sales and no costs. So the reality is in trading, you're gonna have sales, which is a profitable trades, and costs, which is losing trades. But net, you will always make money guaranteed if your average wins are more than your average loss, if your sales are more than your costs. So that's why I teach my trading program. Okay, so I teach both investing and trading. Investing is more of medium to long term. Investing, you buy and you hold it for a long time. Your win rate's about 90% if you pick the right companies. 90% win rate. Okay, but as a short-term trader, you're buying and selling within a few weeks, a few months. Your win rate's about 60%, or at a very most 70%. It's a lower win rate, but you get much higher returns because you have a lot more frequency of trades. And again, your average win is more than your average loss. That's how you generate consistent profits every month as an income source. Another one of my students is Wei Ping from Malaysia, and he attended Wealth Academy more than 10 years ago. Okay, he was a full-time accountant. His dream was to become a full-time investor, and today he has realized his dream. In fact, he was recently featured on the New Paper, one of our Singapore local newspapers, back in 2014 for being one of the biggest online traders today. Okay, and he started, with $20,000, which again is a fairly big sum for most of my students, and he grew that to over $1 million US. Okay, and he just spends about 2 hours every day from his bedroom looking at the markets and making those trades. All right, and that's us together after 10 years. Okay. Let me share with you one last message I got from a student called Eng Bing, and he attended the program 9 years ago. Okay, and it was very heartwarming to receive his message after 9 years. And he said, "Hi Adam, this is Eng Bing here. Just want to drop you a note to thank you for your teachings in Wealth Academy and Patterns of Excellence, which is my NLP mindset program. When I first attended your courses in 2008, my net worth was negative $200,000. I had multiple debts, including those from loan sharks incurred by my dad. Today, I'm completely debt-free." Amazing, right? "Having paid up the debts, including my housing loan, my net worth is now $500,000. To most people, this amount may not be a big deal, but for someone who used to shoplift for food as a kid, it was a huge turnaround. And many of the local media in Singapore, Channel 8, Zhao Bao Wan Bao, which is the Chinese newspapers, reported his story earlier this year. So I'm here to show you that with these skills I'm going to teach you, wherever you are, again, whether you're a finance director from an MNC, you're a journalist like Eng Bing, you're a Davira, a young student, you can generate tremendous income and wealth for yourself. So let me begin by showing you an interesting article that I got from Forbes magazine. And it says that Singaporeans are the fastest people in the world to become millionaires. It takes most Singaporeans less than 10 years to become a millionaire. That's the fastest rate anywhere in the world, says a wealth report released by Barclays Bank July 5th, 2013. And it says here, while the popular belief is that the wealth of millionaires in Singapore has come from the dramatic rise in property prices over the years, that is only partly true. In fact, according to the survey, 72% of the wealth was made from personal investments. In other words, investing in the stock market. So before you learn how to invest, I got a question for you. What returns are you achieving right now? All right, think for the last 5 to 10 years, what average returns are you getting on your money every single year? For example, if you put your money in the bank in a fixed deposit, you're only getting less than 1% return a year. If you're placing into most mutual funds or unit trusts, you're probably getting between 4 to 5% a year at the very most. So spend a couple of seconds and pause the video and to think, what returns are you achieving currently? So go ahead and pause the video and think about it and kind of like write it down. Go ahead. Great. Have you done that? Okay. Now, when I speak to most people, they would tell me that, Adam, I'm achieving, anywhere from, less than 1% a year, putting my money in the fixed deposit to, at the very most, I'm getting 5%. And that is indeed the average returns that most average retail investors get. Okay? Now, if you're getting 1 to 5%, would you ever be able to achieve your first million? Well, yes, but it'll take many, many years to do that. And it's going to be really hard to be financially secure and free because inflation is going to wipe you out. So let's take a look at how your money grows at different rates of return. Assuming if you can invest $1,000 a month, right? Your household income, you save $1,000 a month and you put it aside, how much would you have after 10 years? Well, again, it depends on your rate of return, okay? If you're getting a 5% return on your money a year, you will end up with about $250,000 after 10 years of savings, okay? And if your money grows at 10%, you end up with $346,000. At 15%, you get close to $500,000. And at 26%, you will eventually achieve $1 million in net worth after 10 years of saving $1,000 a month. So you can see that in all these scenarios, you're investing the same amount of money. You're investing $1,000, the same amount, but the results are so different. Why? Because of the power of compounding. So the first lesson to learn is this, that if you want to really build your wealth, the most important thing to focus on is not just how much you save, but it's getting the highest return you can from your capital. Does that make sense? Okay? So if you're only getting 5%, which is what most retail investors get, you can never make $1 million in 10 years, right? If you remember the article I just showed you, it takes the average Singaporean millionaire 10 years to make their first million. So if you do the math, you must achieve at least 26% return a year consistently in order to make $1 million in 10 years, okay? And if you can get a 50% return on your capital, right, you would achieve close to $5 million after 10 years of saving $1,000 a month. Now, a lot of people ask me, they say, Adam, if most people are getting 1 to 5%, is it realistic to think that I can get 20% or 50% returns a year? And the answer is no, it is not realistic if you're an average retail investor, where you've got no skills, you've got no knowledge on investing, and you just put your money in the bank or buy a mutual fund. And of course, you can't get 20, 50%. You should be happy with 4 to 5%. But when you learn to become a self-directed investor, where I'm going to teach you how to time the markets, exactly when to get in, exactly when to get out, how to buy only the strongest, fastest growing companies, how to leverage your capital, how to manage your risk. When you learn all these skills, then getting a 20, 30, 50% return a year is very, very possible, because my students are doing it every single year and so am I. So I'm going to show you right now the different approaches to making money in the markets. So there are basically 3 different approaches to making money in the markets, and you're going to learn all 3 approaches in the Wealth Academy program. So let me give you an overview right now. The first approach is what I call passive investing. Now, passive investing is also known as the buy and hold approach, or the Warren Buffett approach, right? You buy a good company, you buy an index fund, and you just close your eyes, you hold it through ups and downs, and you believe in the company, you believe in the long-term performance of the stock market. And you can also use what is known as a dollar cost averaging approach, where you keep investing a fixed amount of capital so you get an average price over a period of time. So passive investing has an expected return of about 11 to 13% a year on average, okay? But the time frame is a long-term time frame. You have to be prepared to hold the investment for a couple of years, like 5 or 10 or 15 years. But the skill level necessary is very low. You don't need much skill. All you got to do is buy and hold, that's it. For example, if you buy and hold a good company like Apple over a period of a couple of years, for example, you buy it over here, and what you do is once you buy it, you just close your eyes and ride the ups and downs, right? It goes up, it goes down, it goes up, it goes down, and you don't care where it goes. You don't care about the short-term price fluctuations, right? You know that in the long run, it will always go up because it's a good company. It's fundamentally a strong company. So say a couple of years later, it's at 156, you bought it at, say you bought it at 116, right? It's now at 156, and you make, from here, basically the returns all the way to that. So that's known as passive investing. So I'll talk more about that in a short while. Just hang on to that thought, okay? The second approach is known as active investing. And in active investing, we follow the trend of the price. In other words, we don't buy and hold it as it goes down, all right? The moment we notice a downtrend, we get out of the investment and we get back in when the trend reverses back up again. So in trend following, the expected return is about 15 to 25% a year. And the time frame is a medium-term time frame. So you hold it for a couple of months, all right? But you need a certain level of skill, which I call the medium level of skill, where you have to learn to read the trend of the market, all right? For example, you can see that in Apple's case, for this period of time, it was on what we call an uptrend over here. It went sideways, as you can see, the sideways pattern. It went on a downtrend over there, and it went on an uptrend over here. So you must be able to identify, is it sideways, is it a downtrend or an uptrend, and you've got to time your entry, right? So by timing your entry, you know that, okay, you would buy somewhere over here, right? You buy over here, and the moment you detect a downtrend, you would sell somewhere over there, okay? And you would exit before this crash, okay? And then once you identify it's now a new uptrend, what do? You would buy it again over here and ride the trend all the way up. So isn't it better to buy over here, okay, and sell it there, and rebuy it over here and sell it there, right? You make a much higher returns than just buying and holding it all the way for it going down and going up again. All right, so I'm going to teach you in a short while how do you identify these trends and how do you time your entries and your exits. So that's active investing or trend following, okay? Now, the final approach that I'll teach you in Wealth Academy is the approach I use most often, known as swing trading. So in swing trading, the time frame is very short term. I usually buy and sell a stock within a few days or a couple of weeks at the very most, okay? So I'm in and out really fast. Now, to do swing trading, you must use a stockbroker that charges very, very low commissions. So the stockbroker I use only charges commissions of $1 to $3 per transaction, okay? Because if you use a broker with high commissions going in and out, the commissions will wipe out your profit. So you have to use a low-cost broker, not just any other broker. But in swing trading, the expected returns that we get are about 5 to 10% a month. That's right, 5 to 10% a month on average. So it generates some monthly income for you. Now, if you compound it over a year, it's over 100% return a year. Okay. Let me say, Adam, if this is so fantastic, why doesn't everyone do swing trading? Because it's not easy to do it, because it takes a high level of skill where you must be able to get in and get out very fast by reading the price trends on a short-term basis. And in swing trading, we use what we call leverage, right? So leverage means that, for example, if you buy $10,000 worth of shares, you don't actually put in $10,000. You only put in $1,000. So it's a 10% deposit to hold a $10,000 position, for example. Or you buy $1,000 worth of shares for $100. So that magnifies your return, okay? So that even though you buy and sell the shares in 1 week, even though the share price moves by 1%, you magnify your returns to 10% by using leverage. So I'll teach you how to do that in Wealth Academy in a very safe way. And in trading, we profit in both directions. In other words, we make money when the price goes up by buying low and selling high, and we make money when the price goes down by short selling, selling high and buying back low. Okay, so we make money in both directions. Whereas in the first two approaches, you only make money when it goes up. You don't make money when it goes down. So for example, in swing trading, we would, for example, buy over there and quickly sell over there. So we just hold it for a few days or at very most a few weeks. Okay, and when it goes down, we'll do a short sell somewhere over there. As it goes down, we are making money and we buy it back over there. All right, and we buy it over here. It goes up, we sell it over there. Okay, we short sell over here, goes down, we buy it back. Buy over there, sell it over there. So we are going in and out very quickly to the markets, right? So I usually do about anywhere from 15 to 20 trades a month, right? In and out, in and out, in and out. And that's how I make consistent income every month from the markets. And I'll teach you exactly how I do it in Wealth Academy, right? So with that, let's move on to learn more about these different, three different approaches. All right, so let me talk more about passive investing and how you can achieve an average of an 11 to 12% annual return from the stock market with relatively very low risk and with hardly any skills, okay? So how do you do that? First, you always want to apply passive investing into ideally an index, ideally the US index. Now, this is the 30-year performance of the US market, represented by the most famous index known as the Dow Jones Index. Now, first and foremost, what's an index? Every stock market has an index that represents its performance. And the index is a basket of the biggest companies that represent all the companies in the market. So, for example, in the US market, you've got about 7,000 companies. 7,000, right? And out of the 7,000, they pick the 30 biggest companies to represent all 7,000. So in the 30 biggest, you've got Microsoft, Cisco, Intel, Apple, McDonald's, Coca-Cola, you've got PepsiCo, you've got Pfizer, Johnson & Johnson, Walt Disney, Nike, Pfizer, Boeing, and these just to name a few, right? So they take the average price of the 30 biggest companies, and that is known as the index, the Dow Jones Index. So what you can see over here is the 30-year performance of the Dow Jones Index. So what do you notice? Notice that in the short run, the stock market is like a roller coaster, right? Every time it goes up, it comes back down. Every time it goes down, it goes up. It goes up and down, okay? But notice something interesting about the market. Every time the market goes up, it comes down. It goes up, it comes down, 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 like a roller coaster. Okay, but every time the market goes down, in this case this was the crash of '87. What happens? It will eventually go higher. All right. Every time it goes down, this was the dot-com crash. It eventually goes higher. It goes down. This was the financial crisis, the subprime crisis. It goes higher. Goes down, goes higher. So every time it goes down, you always end up going higher. And this pattern has repeated itself for the last 146 years since it began. So the question I ask people is that 5 years from now, 10 years from now, 20 years from now, will the index be higher than it is today? And the answer is a guaranteed yes. Why? Why are we so confident that the index will always be high in the long run? Well, there are three reasons why. Number one is inflation. Inflation will always push prices higher. The second thing is population growth, right? So in 10 to 20 years, there are more people in the world, which means there are more demand for goods and services. So McDonald's has to sell more hamburgers to feed a bigger population. Nike has to sell more shoes. There are more feet in the world, right? So companies have to always grow indefinitely. That's why their share price keeps going up. The third reason is this. The 30 companies in the Dow Jones or in the index are not always the same 30 companies. Right? They change all the time. The moment a company is no longer a market leader, it's dropped from the index and replaced by a better company. So for example, Citigroup, AIG, General Motors, Bank of America, they were in the Dow Jones in the past. But about 7 years ago, they were kicked out of the Dow Jones because they were not doing as well financially. And they were replaced by 4 better companies, which was Visa, Apple, Nike, and Goldman Sachs. So in other words, it's always the best 30 companies that represents the index. And because of that, the index is engineered to always go up in the long run. Okay? So if you know that the index will always go up in the long run, you have the confidence to buy anytime and close your eyes through the ups and downs, because in the long run, you always make money. Right? So imagine if you had bought the index, for example, over there, back in 1985, right? And you close your eyes and you went up and down, you didn't care, you didn't bother. When it crashed, you didn't get worried, you didn't kill yourself, or you just kept holding and, in fact, buying more, right? And if you open your eyes today, after 30 years, would you have made money? Yeah, you have made the gradient of this line, right? From here, your wealth would have grown to there. So that's a total of a 991% increase in your wealth by just closing your eyes for the long run. If you annualize it, it accounts for an 11.84% annualized return on your money. Your money is compounding, growing at about 11 to 12% every single year. So basically, the first lesson you've learned today is that you can make an average of an 11 to 12% annual return with little risk by buying and holding the US index for the long term. Okay? Now, how do you buy the index? You can't buy the index directly. You can't go to 7-Eleven and say, one index, please. You can't do that, right? You have to buy something that tracks the index. And that something is called an ETF, or an exchange traded fund. So every index has an ETF that you can buy that tracks that underlying index. So for example, if you want to invest in the US market in the long run, you can buy the Dow Jones ETF. And you can buy it through any online stockbroker in a couple of minutes for a very low commission of $1 to $3, right? Which is what I do. Or you can buy the S&P 500 ETF. Now, if you believe in other markets like China or Russia or India or Singapore, all of them have their own ETFs as well. For example, if you believe in China, you can buy the China ETF that tracks the Shanghai Composite Index. Or you can buy the BRIC ETF that tracks BRIC, Brazil, Russia, India, and China. Okay? And if you do that, you get, again, a very good return over the long run. I've been teaching ETFs all my life. In fact, back in 2006, I was one of the first persons in Singapore to go out and teach ETFs. And the Singapore Stock Exchange put me on the cover of their magazine. This was back in 2006. The Singapore Exchange had a magazine called Pulses. And at the time I went on and told people, I said, buy the US ETFs, hold it for the long run, and you're bound to make money because the ETFs will always go up in price in the long run. And to today, I've got people who send me emails and say, Adam, thank you so much for the advice. I heard your talk 10 years ago, I bought those ETFs, and today I'm making phenomenal returns. In fact, if you had just bought the Dow Jones ETF, which is what you have here, the Dow Jones ETF, if you had bought it back in 2009, it was selling at $75 per share. And there's no minimum. You can just buy one share for $75. If you've got $75, you can buy one share of this ETF. And if you had held it, for the last 8 years, it's now, in fact, it's over $214 per share right now. So that's a total return of 184% on your money in the last 8 years. And if you annualize it on an annual basis, it's equivalent to a 13.96% return a year. All right, so you see that most people are getting 1% to 5% returns a year. It's, you can do so much better. If you just bought the US ETF, you get 13.96% return a year. All right, and you may say, Adam, that doesn't sound exciting, but I can tell you that if you just get a 12% return a year consistently, even as an average income earner, you can become a millionaire in your lifetime. Let me show you the mathematics behind that. All right. Imagine if you earn $5,000 a month. That's the average salary of a Singaporean. So I'm just taking that as an example. If you earn $5,000 a month, that's $60,000 a year. Okay? And if you work an average of 30 years before you retire, you would have earned a total of $1.8 million. But for most people, after 30 years of hard work, they will not see $1.8 million, right? Because most of their money would have been spent on taxes, GST, and so on and so forth. They got hardly anything left for retirement, right? But imagine if you could just save 10% of your salary. That's it, just 10%. Which means every year you save $6,000, right? And what do? You just buy the US ETFs every year and you just close your eyes. It goes up and down. You don't care. Hold it for the long run. And every year you're putting in 6,000 and 6,000 every single year, and it's compounding at about 12% annually, like they did for the last 30 years. And if you do that, you find that how much would you have after 30 years of compounding? And the answer is this: if you save $6,000 every year for 30 years, and it's growing at 12% based on the average of the index growth, that gives you, at the end of your working career, $1.6 million, which is almost everything you've earned in your lifetime. So think about it. If you just save 10% of your salary, put it into the index, and close your eyes, you end up with almost 90% of everything you earn in your life. And this is just passive investing. I can tell you that you can do a lot better than this. This is the simplest way to make money. And it's the lowest return that you should accept, because you can do a lot better with active investing. And I'm going to show you active investing in the next slide. So stay tuned for that.